All right, welcome back to the channel. So, I usually try not to get sucked into YouTube finance drama, but every once in a while something so insanely ridiculous and stupid happens. I feel like I have to I don't have to, I just want to chime in on it. So, yeah, everything money. Everything money and Paul. It's been pretty well known that he's fairly bearish, especially when it comes to tech. He's been pretty negative on NVDA. He's been pretty negative on the Qs. And it's come to light, recently, not even recently, probably over the last couple months, that he does have an NVIDIA short position. And then some more information started coming out about how he structured this NVIDIA short position. So what we know, and I just want to talk about this because it's so ridiculous and it's so dumb that I'm just flabbergasted by it. So what we know from various Everything Money videos is that he took the short position by selling naked calls. He did so with June and December 2025 contracts. The total upside of basically the position is a couple of million. His family account. It's not funny. It's not funny. It's serious. His family account got margin called, and there's been some family drama in related to this short position, which he's now down probably a significant amount of, and we're going to talk about that. So first, let's go into what a naked call is and selling a naked call. So basically, you can buy calls, right? And a call allows you to get exposure to 100 shares of a security, and there's a certain strike price involved. And let's go over here, and I'm going to actually open another link up, and we're just going to go through the basics of a call. All right, so let's build long call. We're going to say NVIDIA, and we got let's do the June 2020. The call is $4.95. The premium essentially is, what would that be? That would be about $115 premium on the contract right now. And then, so 11,500 for the June 2025. And I think that's correct. Yeah, 115, I believe. So the net debit would be 115. And then you get exposure to 100 shares of NVIDIA at a strike price of, right now, this says $4.95. Now we could change that to 500. Yeah, whatever. We could change it to, $6.30. And you have to pay less for those calls, but the strike is further out, right? $630 per share. So basically, what Paul was doing was he was selling these calls, right? He was selling these calls without them being hedged. What that means is that he didn't have any long calls or long common stock that related to NVIDIA to hedge the downside. Now, if we go into a graph of a normal call, we can see that your upside is, or your losses are limited to 100% of your initial cost of the call, assuming it expires worthless. But your upside can be, pretty drastic. If the stock goes up to, the moon, then you can get, hundreds of percent in gains. Now, what we can do is we can go and we can build a short call, which is what, it's advanced. It's a naked short call. It's advanced. So Paul must be really smart then, right? So we're going to do that. And we're going to say, now this has to go off of right now, our current time frame, and we'll back test what I think he probably did. But let's say that we're selling a $500 call, and what we can see here is that we're going to get a nice credit for selling this call. Okay, we're going to get a nice credit of 11,500 for selling that call. Let's go to 500 actually, 500 strike. So 11,200. It's basically at the money. We're pretty much selling an at the money call, so our premium is pretty good. It's a $11,710 premium per contract. But here's the thing. So if we're selling a naked call and the stock goes up, well, your losses are unlimited. So you're capping your total gain to the premium you receive, right? And then we can increase the range here, and we can see that the max loss, as so nicely defined in option strat, the max loss right here shows infinite, right? Infinite. So you might make 11 grand if they expire worthless and you're selling these calls. You also could lose, an infinite amount of money, which I don't know about you, but that sounds like a pretty bad deal. So this is what is referred to as, I think some people would refer to it as a premium harvesting. You're selling basically insurance or an option, and you're harvesting that premium, hoping that in this scenario that the price of the equity would go down below the strike and expire worthless. Now, if NVDA goes up to $1,000, then you're kind of hosed. You're going to be on the hook for the spread between that $500 or $490 strike price and the $1,000 trading price at the time of expiration or at the time of redemption. All right, so now that we got that basic information squared away, we can see what kind of Paul was doing, okay? He was selling naked calls in order to short NVIDIA, which I would argue, and I think a lot of people would argue, is very, very, very stupid way to short a highly volatile stock with massive amounts of tailwinds. Even though it could be long-term overvalued, the market can remain irrational longer than Paul can remain solvent. So from the video information that we had, he did it via naked calls, selling naked calls on June and December 2025 contracts, which means he was reaching out further in time, probably trying to get a higher premium harvest because the time duration was longer. Okay, so he's like, "Ooh, hey, that's a good yield. I can sell them way far out, and NVIDIA will definitely be below, 200, 300, 400 by the time the strike comes, and then they expire worthless." Yeah, great idea. In one of his private videos, he mentioned that the total upside of the position he took was a couple million. Okay, so what this would mean is that he sold enough contracts to harvest a couple of $1 million in premium. So, that's quite risque. We know via some videos that the family account where this position was held, where he basically took a couple $1 million in premium by selling contracts, got margin called. Usually that's going to be around a 30 to 50% margin ratio, something like that. So he had a substantial short position on NVIDIA, obviously, even relative to the account size. We know that there's some family tension, and then the rest we kind of have to, I don't know, figure out ourselves, right? So I'm going to be assuming that he was selling at the money or in the money contracts for the best premium harvesting. The position, I think he established it probably January to May, somewhere in the beginning to the midpoint of the year. Now, if we take all that put together, we're going to look at some charts on some different option contracts, right? And let's go here first. We have a June 25 contract at a $200 strike price, right? And if we look at the historical chart, I'm pretty much going to try to line this up to where he's selling at the money for the best premium harvesting, because I think that's probably what he did. So if you look at the chart, we have the underlying NVIDIA right here where that cross arrow is, right, moving. So if we look there, it was crossing about $200 right around going into February, right? Right into February. So if he used these contracts, well, we know that he used the June 25 and the December. So we know he used this expiry. If he was selling at the money, it would have been right around beginning of February. So these contracts would have harvested him probably around $70 to $85, maybe $90, $100 in premium. Okay. And that's, ooh, lights flicker. And that is premium per unit of exposure. So since it's 100 stock units of exposure, it'd be times 100. So he would have been getting probably around $7,000 to maybe $10,000 per contract that he was selling naked at this time, assuming that's when he was doing it on this strike. And we can see that now he would be down about 2-3x that. So currently these are obviously deep in the money now. So he would be on the hook for about 2 to 3x that. That means, and this is a pretty reasonable case. I'll show you some worst cases in a little bit, but that means he would be, he'd be down probably about, so 3 million times 3, 9 million, 2 millions times 2, 4 to 9 million if he loaded all in at that specific time. What I think he most likely did, I think he probably staggered. And I think that's why he referenced having June and December at different time frames, because I think he was waiting for the Decembers to come available, and then he probably staggered into those. So most likely he probably has contracts maybe for June and December time frames, but the strike prices are probably anywhere from 200 to 350, depending how long it took him to stagger this position in. So this one is for June, is for 250. And we can see, if he was establishing this, basically, if he was establishing it right away, it's $40 a contract, and now it's up to 271. So yeah, that would be rough. That would be 15, 20 million loss right now. But let's say you staggering into this around the April-May time frame, they would have been around 96 to maybe 120 a share or a contract. He'd still be down 100, 200, 250% on that. And then we can look at and these are 250 strikes, and then we can look at the $300 strikes expiring in June. And what we see there is kind of more of the same. If he was establishing in this kind of pump, this run up before it gapped up above new highs, he'd be in these contracts for about 60 to 70 some dollars, and they're worth about 230 now. Now, if he was looking at December's, and this is why I think he had June and December, because you can see the Decembers weren't available until almost April. So I think he was staggering to June expiry contracts, and then moved into December as time went by, and December became available, 2025. But kind of more of the same, unless he was. Maybe he bought some up here, or sold some up here, and in that case, he's still down probably 50% on those contracts. I really lean towards, we knew he was talking about shorting QQQ going into the end of 2022, into 2023. He's also talked about shorting NVDA at that time. Now, the really scary thing is that if he was not selling at the money, if he was selling out of the money, well, then he'd be really screwed, because we could look at some December 400 calls of 2025, and if he was establishing a position in these, over in February, he would have been selling them at about $20 to $30 a contract. They're up over 160 right now, so that would be almost like a 10x loss, coming up on a 10x loss. But most likely, he said total upside, if all of them expired worthless, was about a couple of million, so 2 to 3 million. Just from the options pricing, the history, the charts, and the time frames where I think he was accumulating, he's probably down 5+ million at this point, trying to recover that. And we'll see. That's a lot of exposure too, because if NVIDIA goes to $1,000, just say something crazy happens, right? Tailwinds are longer than expected. NVIDIA just soars. He could be down tens of millions of dollars, or more. That's scary. hopefully, if he's smart, he's put on a hedge right now. He's maybe bought some long contracts or something like that. But yeah, scary stuff. And be careful who you listen to out there. Because obviously there are people that have a lot of subscribers, that have a pretty big following, that have no idea what they're doing at all. This is ridiculously irresponsible. And just the fact that he had a large enough position of premium harvesting to get margin called on the account tells me that his allocation was like horrible too. He was probably way too heavy trying to harvest premium, and now he's probably, down 200-300% on those contracts, which means he's down probably 4 to 8 million. This would be my assumption, and potentially might get worse. I think NVDA is kind of hovering right around all-time highs now. Let's see, 5-year. Yeah, we can see it looks like it's about to break up. So maybe it does. I'm gonna root for it. So, man, well, in all seriousness, I mean, hope the guy's okay. That's rough. I mean, he plays it off like it's no big deal, but dang, like, I think he's down at least 5 million. He could be worst case scenario. Some of these, if he was, selling these contracts, these June contracts in, at when they got created at $40, that's almost 10x. I mean, that could be like 15 mil, being down 15 million. Yeah. And yeah, shorting is dangerous in the first place. Doing it this way is absolutely insane. You are accepting so much risk for limited reward, and you, as Paul has learned, can get absolutely wrecked. So hope you guys are having a great day. Enjoy the weekend, and enjoy the New Year's season. Let's bring on 2024. It's going to be a good one. We'll catch you later.